Welcome to a special Friday all mailbag edition of Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast and foggy Redmond, Washington. Thanks for joining me every weekday after the close for our show. It's been such a pleasure to get the show relaunched here and navigate these markets with all of you. You know, we get a lot of great questions through the course of a normal week with Chart This. And so I like to take some of the questions that I've received, turning them into an all mailbag edition to really focus on some of the key questions that have come up in the course of these normal discussions. Before we get to the questions we're going to share with you today, did want to remind you the Market Misbehavior podcast is live and ready. We're posting episodes on our YouTube channel called Market Misbehavior. We've had 4 episodes so far. Most recently, sat down with Mike Singleton of Invictus Research. Mike's a really smart analyst, strategist, focuses really on the macroeconomic environment, but also with a kind of technical behavioral overlay, sentiment, and so forth. And I really love that. So in our conversation, we talked about price momentum and buying on the dips. But we also talked about job growth and GDP and, really different ways to think about economic strength or weakness and how that relates to stock prices, including some economic indicators and graphs that I really hadn't thought about considering before. So please make sure you go check that one out. Also had a discussion with Joe Rabel of Rabel Stock Research this week, as well as Miss Schneider of MarketGates. 3 really cool episodes. So please check them out if you could, and appreciate your comments as well. All right, let's continue today and go to question number 1. The first question, Dave, does oil have much correlation to the S&P and NASDAQ as far as if oil prices are high, the economy is doing well, or if oil prices are down, the economy is not doing well? Interesting question, to be sure. And I will tell you, the answer is kind of, right? With crude oil, I think what you have to remember is what you're kind of hinting at, right? When you look at CPI, which came out on Thursday of this week, there's CPI, which includes a number of different things, right? So it's the, kind of classic measure of inflation, right? How much do things cost now versus a year ago or a month ago or whatever comparison you want to make? And that's sort of that 2% bogey that the Fed has talked about as a year-over-year 2% appreciation in prices. Now, you also do core CPI that excludes food and energy, because those 2 series in particular can be quite noisy. And so core CPI kind of gets to those sort of those basic necessity kind of purchases that are less choppy and volatile. To directly answer your question, I would say no, there's not as much of a direct relationship between crude oil prices and the economy and the stock market. And the reason is because there are a lot of other things happening, right? I mean, crude oil is one of those things. We obviously have a conflict in the Middle East, the scope and scale of which is still unclear, continues to become have more and more of an impact. And so what that does to crude oil prices is a question mark. You also have the whole evolution of electric vehicles and the move away from traditional fossil fuels into electric. Tesla had a big event on Thursday of this week, unveiling the new robo-taxi. That also will impact crude oil prices, right? Because of the changing demands for fossil fuels and how we're fueling our cars, how we're actually getting the energy to fuel the electric cars is another piece of that as well. From a technical perspective, this is the chart that I like to share. This is a 20-day rolling correlation. I'm showing the S&P, and then at the bottom, it's the correlation between the S&P 500 and crude oil futures. And a 20-day rolling correlation is a kind of a great way to just, basic assessment, how closely are these 2 data series related. And if you're not very statistically minded, or if you're not familiar with this stuff, correlation coefficients kind of go from -1 to +1. A +1 means a perfect positive correlation, meaning when this thing goes up, the other thing goes up about the same amount. It's kind of what that means. -1 would be the opposite. When this thing goes up a bit, the other one goes down a bit, and that is a pretty consistent relationship. The correlation around 0 is really the absence of a relationship, meaning one of these is moving and the other one is maybe not, or they sometimes move together and they sometimes don't, but it's not a very consistent relationship that you can bet on. And if you look at the evidence over the last 2 years, just as an example, stocks and crude oil at times have moved together to the upside, at times have moved opposite to one another. It's very noisy. And that's actually the case with a lot of things. So, conventional wisdom would say, airlines probably are one of the industries with a direct relationship with, or should have a direct relationship with, fuel prices, right? Because it costs a lot of money to fuel airplanes, and that's kind of the business, is shuttling people and cargo around the world. So, if crude oil prices are higher, shouldn't that be bad for airlines? And if crude oil prices are lower, shouldn't that be better for airlines? That is what the conventional wisdom would be. And in some cases, that could certainly be true. But what I tend to think of it is, it's not a perfect correlation, right? And so this should be an inverse correlation. Airlines should do poorly when crude oil prices are up, and airlines should do well when crude oil prices are down. But again, if you look at the correlation, it's not the case, right? And there are times when that relationship completely is inverted. And so I think what you have to remember is, these are headwinds and tailwinds. These are tendencies, but a lot of other things affect airlines, right? How much people are traveling, right? Weather conditions, all these sorts of things. Interest rates, how much money people have for frivolous fun trips to different places. All of that impacts airlines, and competition, and all of that sort of thing as well. A pandemic would affect airlines as well. The only sort of thing that I would say has a pretty consistent correlation to crude oil prices would be energy stocks. So here we're looking at the correlation of the XLE, the energy sector, versus crude oil. And while, again, it's not perfect, and there are times when this correlation falls apart, think of these last two charts and look how noisy the relationship is between the S&P and oil, between airlines and oil. But look how energy and oil, pretty consistent, and often, kind of above positive 50.5 correlation. So that's one of those more consistent relationships that crude oil has. For other things, I would say it's usually pretty noisy, and so I've found to pay a little less attention to that, or assume less of a direct relationship than you might. The logic of some of these relationships doesn't actually map to the reality of what's happened. That's why I would argue charts are such a brilliant way of really understanding relationships. One of my analysts at Fidelity used to say, charts are the truth serum for the markets. A lot of times we think about what a relationship should be. Charts will tell you what the relationship actually is, and a lot of times it's not what you might expect. Next question, and thanks for that one. Dave, what's the history of the VIX index around presidential elections? Curious if the VIX drifts higher into the big day in November. Does that make the VIX a good indicator of risk over the next? I combined VIX and risk into VIC. The good indicator of risk over the next few months, given a specific event risk that is coming on the calendar. Great question as well. And again, we have charts coming in as the truth serum for the markets. Here, what I'm doing to answer your question, and thanks so much for that one, is to look at the VIX in the top panel and the S&P 500 in the bottom panel. Now, here I'm actually looking at a weekly chart. I'm going back about 10 years just so we can get a couple different election cycles under our on the view here. And again, this is not a statistically significant number of observations. Going back 10 years, we've got 3 different election years, including this one. But you'll see that the answer is no. It's not a great. It doesn't do specific things in an election year, right? So here's 2024, kind of going into an election year. Really, in the last couple months, volatility has spiked quite a bit. 2020 was the last election year. Now, that was an unusual one, of course, because this was the kind of the meat of the COVID era, right? So there's the spike in the VIX as the pandemic sort of really heats up. And then as things went on, the VIX remained above 20 for the entirety or the rest of 2020, but actually came off a bit going into Election Day. 2016 was the last one. The VIX was actually, pushing above 20 just slightly in October. But by November, by Election Day, volatility came off a little bit. So just with those 3 examples, the VIX has looked very different in each of those times. Again, I think similar to what I said with crude oil, what you have to remember is, the markets have a lot of different things going on. As much as we think about the election impacts on the markets, a lot of other things tend to have more significant impacts, I would argue, right? I mean, if you think about potential market moving events in 2024, there are a lot of things I would say that are before the election in terms of implications for the broad market, right? So things like events in the Middle East, hurricanes and their destruction are part of that. Probably more than anything, economic conditions, particularly the Fed, interest rate environment, inflation. Those are things that I think are directly related to risk assets, and that's where I would be focusing my attention. What I've found with elections, and again, I'm often asked what happens if a Republican or a Democrat wins. What happens, in all these different combinations of what the outcome could be. And I would say that, to me, one of the biggest takeaways is leadership themes, right? Think about who would win, and then think about what sort of policies they would most likely enact, and think about what types of companies and industries and sectors would tend to benefit from that. That is a thought process that I think has been fairly helpful. But in terms of the broad, relationship between volatility in election years, I think it's more about the broader market conditions along with the elections, and not just elections on their own. By the way, if this is something you're thinking about, which I know many are, I do think there are some things to consider going into election season here, 2024. Things are heated up. It's a contested election. I like to think of it, as I mentioned, in terms of what kind of industries and themes will do well, most likely, given different administrations. What sort of themes will likely do well regardless of who wins? And that's where I really like to focus. Think about more about the sort of the regime that we're in, and sort of the evolution of different technologies. We're going to talk about all of that at a free webcast coming up next week on Tuesday, October 15th, 1 p.m. Eastern. If you go to marketmisbehavior.com/election2024 or scan the QR code that you see on your screen, please join me as we talk about some of the ways to approach the seasonality around election years, what's happened in 2024 versus what usually happens. And then we'll spend some time looking forward and think about, talk about some ideas about how we could position ourselves going into, and especially coming out of the election day here coming up in less than a month. As a reminder, marketmisbehavior.com/election2024, or just scan the QR code. That's a free event coming up next Tuesday, 1 p.m. Eastern. Next question. Another VIX question, by the way. It's almost an all VIX question, but not all. When the VIX is high, and I love this quote. Thanks for sharing this. When the VIX is high, you got to buy. When the VIX is low, you got to go. When did it replace the put-call ratio? I spent years relying on the put-call ratio. Aren't they synonymous? A lot to unpack in that particular question, and I would say no, they are not synonymous. Number one. I love that. I don't know if I've ever heard that. When the VIX is high, you got to buy. When the VIX is low, you got to go. And I get it, right? Because when the VIX is high, right, when you have an extreme high reading, that usually lines up with market bottoms, because peak panic is usually the bottom, right? That's when everyone's kind of panicked and sold out. That's when the panic selling has occurred. And if you have a long enough runway, that's really when you want to start accumulating long-term positions. Some of the best buys I've ever made, long positions I've ever taken on, have been at major lows. And 9/11 and sort of the 02, 03 lows were early in my career. And I remember buying things like Royal Caribbean and things like that, just basically because they've been so bad, beaten down so quickly. And it was sort of like are people ever going to want to cruise again type of questions. And sure enough, those all recovered obviously quite well. And so that was, for me, one of my formative experiences of buying price weakness with a long-term time frame. Fan of that. And the same thing, right? When the VIX gets pretty elevated, it usually lines up pretty well with, when the VIX is very, very low, usually lines up with market peaks, right? So at major market peaks, VIX is usually kind of in the low teens and occasionally even below 10, which doesn't happen often. So that is a pretty good inverse relationship, I would say. Now, you asked about the put-call ratio. So number one, they are very much not the same, right? The VIX is looking at options volatility. It's looking at the S&P 500 index options and looking at the movement in the price action of those contracts, and then using that to imply a volatility for the broader market. And that's what the VIX is really reporting on. Put-call ratio is actually looking at positions, put positions, and call positions, right? And what we've seen on the put side and the call side, with the idea that when the market goes up a lot, people kind of start to get really bulled up. And as a result, you have peak, sort of bullish positioning. And when the market comes down, People are getting super, super nervous. You have peak bearishness or way more puts than calls. And so there's an inverse relationship here as well. So you're right in the fact that there is an inverse relationship, generally speaking, between both of these series, the VIX and the put call ratio and the S&P 500. But they are measuring two very different things, to be honest with you. What's interesting is, the put call ratio, if you look at it, just in the end of September, was at one of its lowest readings. Now, I actually do a 5-day moving average of the put call ratio. That's the series that you see in pink. The raw data is in gray. And the reason why I smooth it out with a 5-day moving average is because the day-to-day movements are actually super noisy. It's a very choppy data series, and it changes dramatically from one day to the next. So by smoothing it out a little bit, you can think a little bit more about the trends and how it's moving over time, and not just one day or one particular movement. So we have been at a fairly low put call ratio here over the last, really from late September. Right now, it's kind of back up to the middle of the range as the S&P has gone higher a bit. To be honest with you, I use the VIX way more than I do the put call ratios. I tend to pay attention to put call ratios when they're at extremes. So when the average reading gets very high or very low, I think it's pretty important to pay attention to. For what it's worth, I think it was one of those indicators giving a bit of a contrarian bearish sign at the end of September. We had a brief pullback, but obviously here we are making new all-time highs again in the last week. Final question, and then we'll wrap it up for a Friday. I want to thank you guys so much for sending in your great questions, putting them in the comments. And as a reminder, during our live broadcast, just put the question along with wherever you're streaming the episode. If you're watching the show on YouTube after the fact, just put a comment below that video. I'll get as many of those questions as I can and pop them in the mailbag for a future episode. Final one, Dave, just wondering if you use the volume on the S&P 500 index as a guide when considering breadth. Really interesting question. The short answer is no. And if you follow me in my work, you'll see that I use volume very, very little. I earlier in my career used volume quite a bit. And what's changed, right? Well, I've been in the industry for over 24 years, and I started right in mid-2000, right? Literally as the market's peaking out, the tech bubble is bursting. That's when I kind of got started looking at charts a lot. And I will tell you that volume was a very important part of my process early on. And a lot of the great, books that I would read on technical analysis and investing talked about the importance of volume and looking for volume confirmation on breakouts or breakdowns. Over time, though, I saw a lot of indicators that had worked really well, like in the 80s and the 90s, started to not work as well. Things like money flow, not Chaikin money flow. This is Laszlo Barini's version of money flow, which looked at tick data, trade by trade tick data. Started to not work at all for NASDAQ stocks, even though it had worked brilliantly before then. The rise in hedge funds and over time, dark pools, high frequency trading, algorithmic trading, all of these things I would argue have changed the way that what the volume reading actually represents, right? If two hedge funds just have a ton of volume trading between each other, the volume spikes on the consolidated tape, but it's not a big institution making a directional bet. And 50 years ago, a stock moving on big volume was a big money manager taking a big position or unwinding a big position. So you could draw that kind of direct assumption. All right, this is moving on big volume. That means big institutions are buying. Now it could just be a lot of volume for other things. Could be hedging, could be a bunch of other stuff. Rising up the options market, I think, is a part of that as well. So I think it's just less clear. And so as a result, I've learned to use volume less and less. Having said that, I do think there's some value to it. And I will tell you the two ways that I do use it. And answer your question directly, by the way, I don't use volume when considering breadth. I think of those as two different things. There are some breadth indicators that are measuring volume readings, but not as common. And most of the breadth indicators that I've shared, as I'm thinking through them very quickly as I'm talking, I don't think any of them really include volume, right? It's really more price action, looking at whether they're going up or down, whether they're in a point and figure profile, whether they're breaking a certain level or holding a certain moving average, making new highs or lows. Like that's what breadth data is usually based on. It's not as much volume. I would say volume is a separate sort of data series or thing to include. If I was using volume, and I think the general way that I would think about volume, and I do it occasionally, I just don't. It's not my default way of thinking about it. is I would think about volume in terms of its relationship to price movements, and that's kind of what you're implying, right? If you see a big move in the market, is it supported by heavier volume, right? And particularly when you see the trend in volume over time, right? So one of the things that I would take away here in October is the market is going high, and the S&P is not a great thing to let's do like the SPY. There we go. So if you look at the trend in volume just in October, right, the market's overall been pushing higher, making new all-time highs, but look how the volume is actually lighter and lighter. So you have this divergence right now, and that is something that I think is very helpful. When the market moves and there's volume support, that means something that's encouraging. When the market goes up and the volume lightens up, that does imply some sort of change. And so I think if I was using volume more, that's definitely the main way I would think about it. Also, remember what's really cool is that daily volume readings are kind of a very simplistic way of measuring it. There are a lot of things you could do, and just on stock charts like Chaikin money flow, accumulation, distribution, these are more nuanced ways of really looking at changes in volume, trends in volume on up days and down days. All of the on balance volume is a simple way of doing that as well. Those are the types of things that I think are quite helpful. And, even with the S&P, right, if you look through the course of 2024, here was the rally that you saw in the first, 4 months of the year. Then all of a sudden we're making a new high here at the end of March. And look how the Chaikin money flow flipped negative. And then once we bottom out in April, we see the Chaikin money flow turn positive. And then we see it turn negative. And you see it turns negative very soon in the pullback phase. And so using something like that to recognize that this is what this is basically doing is looking at the volume, more distribution volume versus accumulation volume. There are a couple indicators that try to do that. This has been a really interesting way, certainly of identifying some of the tactical pullbacks, major pullbacks within 2024. So if I was using volume, I would use it in those couple ways. I would say the volume that you've seen in October so far, not particularly strong. It's been a lighter volume kind of month relative to September. Something like the Chaikin money flow still constructive in terms of the overall accumulation on the up days. Look for that Chaikin money flow to turn back below zero. That's one of the things I would certainly be looking for. Not exactly like breadth analysis, but an interesting way of thinking about changes and perhaps shifts in volume. Folks, thanks so much for joining me every weekday after the close for Chart This with Dave Keller. I can't tell you how much I appreciate all of your support, your great questions, and just for tuning in and supporting me in what I'm trying to do. My goal is to help you make better decisions by improving your market awareness. And if by watching the show allows you to do so, I'm super happy for that. You can find more info about me or my premium memberships, free resources to learn more about technical analysis and behavioral investing at marketmisbehavior.com. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts. Have a great weekend.